There's a financial time bomb ticking in the heart of the American economy, and it's about to go off. In 2024, a critical economic indicator just surged past its 2008 crisis levels, signaling that a key pillar of consumer debt is beginning to crumble. This isn't a complex derivative or an obscure Wall Street instrument. It's the simple, everyday car loan. Millions of Americans are now caught in a debt trap that was engineered by the very institutions that were supposed to serve them, and the consequences are unfolding stage by stage, decision by decision, almost like we're following a script that led to financial catastrophe before. This is the story of how an essential part of the American dream, the freedom of owning a car, became a nightmare of unsustainable debt, and why the math says the repossessions are just the beginning. Auto loan delinquencies and defaults have just exploded, reaching their highest point in over a decade. The numbers are now officially worse than they were at the peak of the 2008 financial crisis, a period we once thought was the benchmark for economic disaster. This isn't a minor fluctuation or a statistical blip. It's a massive red flag waving over the entire consumer credit market. We're witnessing a wave of financial distress that was entirely predictable, yet largely ignored by the lenders and policymakers who created the conditions for it to thrive. The root of this crisis is a perfect storm of economic pressures. Millions of borrowers are falling behind on their payments because the cost of owning a vehicle has spiraled out of control. Car prices themselves hit record highs during the pandemic supply crunch, but the pain didn't stop there. Insurance premiums have soared, and interest rates have climbed relentlessly, turning what was once a manageable expense into a crushing financial burden for households across the country. The data paints a grim picture of an affordability crisis that has reached a breaking point. The average monthly car payment in the United States has now surged past $750. For many families, that single payment consumes an enormous portion of their monthly income, leaving little room for groceries, rent, or other necessities. It's a figure that is completely unsustainable for a huge segment of the population, a ticking clock counting down to default for millions who are just one missed paycheck away from disaster. At the very center of this implosion are the subprime borrowers, those with lower credit scores who were targeted with the riskiest loans. These individuals now account for a disproportionately large share of new auto loans, and they are defaulting at truly alarming rates. It's a classic playbook. When the economy feels strong, lenders push the boundaries of risk, extending credit to those least able to handle a downturn. The music has now stopped, and these borrowers are the first to be left without a chair. This wasn't an accident. It was a deliberate strategy. Lenders aggressively expanded risky auto credit during the pandemic, operating under the assumption that government stimulus checks, enhanced unemployment benefits, and record low interest rates would last forever. They built entire business models on a foundation of temporary government support, ignoring the obvious risk that once the support was gone, the defaults would begin. That assumption has now proven to be catastrophically wrong. A huge part of the problem is that many of these loans were issued for vehicles that were massively overpriced to begin with. The pandemic-era used car bubble created a situation where people were borrowing huge sums for assets that were guaranteed to lose value. Now, those cars are depreciating faster than borrowers can pay down their loans, creating a scenario where millions of people are underwater, owing more on their car than it's actually worth. This negative equity makes it impossible to sell the car to escape the debt, trapping them in a downward financial spiral. The front line of this crisis is now overwhelmed. Repossession companies are reporting unprecedented backlogs. They literally cannot keep up with the sheer volume of vehicles that need to be taken back from defaulting borrowers. There are simply too many cars to repo, a physical manifestation of the financial chaos brewing beneath the surface. Armies of tow truck drivers are working around the clock, but the wave of defaults is growing faster than they can respond. And this time, technology has made the process of repossession brutally efficient. Modern vehicles are equipped with systems that make it easier than ever for lenders to reclaim their assets. Cars can be remotely disabled with the click of a button, leaving a borrower stranded. GPS trackers, often installed without the owner's full understanding, allow repo agents to locate a vehicle within hours of a missed payment. The technology that was marketed as a convenience has become a tool of financial enforcement. As this wave of repossessed vehicles floods the market, a new problem is emerging. Used car prices are now falling sharply from their pandemic highs. This means that when lenders resell these repossessed cars at auction, they are often unable to recover the full amount of the outstanding loan. They are left holding significant losses, a dynamic that puts immense pressure on their own financial stability. The bubble that inflated their profits on the way up is now costing them dearly on the way down. This stress is now starting to appear in a place that should sound alarm bells for anyone who remembers 2008. Auto loan-backed securities, ABS. These are the complex financial products created by bundling thousands of individual car loans and selling them to investors. Just as with mortgage-backed securities before the last crash, these ABS are beginning to show signs of stress as the underlying loans go bad. These are the same early warning signs that the financial system ignored a decade and a half ago. In response, some of the smarter players in the market are quietly heading for the exits. We're seeing lenders begin to tighten their lending standards, making it harder for new borrowers to get approved. Others are exiting the subprime auto loan market altogether, a clear signal that they see a significant downturn ahead. They are trying to reduce their exposure before the crisis fully hits, but for many, it's already too late. The danger isn't confined to subprime borrowers anymore. Rising unemployment and wages that have failed to keep pace with inflation are now making even prime borrowers, those with good credit, vulnerable to delinquency. The economic pain is spreading up the credit ladder. When people who have always paid their bills on time start to fall behind, it's a sign that the problem is not just about individual financial discipline. It's about a systemic failure of the economy to support its own citizens. This crisis isn't just about consumers making bad choices. Entire business models were built on the assumption of ever-inflating car values and perpetually cheap credit. Car dealerships, lenders, and even Wall Street firms all profited immensely from this bubble. They encouraged longer loan terms, riskier credit, and higher prices, all while knowing that the model was fundamentally unsustainable. They are just as culpable as the borrowers now facing repossession. The risk is now spreading to the core of the financial system. Banks and credit unions with large portfolios of auto loans could face growing and potentially catastrophic losses if the default rate continues to climb. Regional banks, in particular, are heavily exposed. The failure of a few key lenders could trigger a chain reaction, echoing the banking crisis of 2008, but this time sparked not by mortgages, but by cars. The repossession data reveals a stark and widening wealth divide in America. It is overwhelmingly working-class borrowers who are getting hit the hardest. For these families, a car is not a luxury. It is an essential tool for survival. It's how they get to work, take their kids to school, and buy groceries. The loss of a car is not just an inconvenience, it's an economic death sentence. In a desperate attempt to keep the sales machine running, auto manufacturers have resorted to a dangerous gimmick, extending loan terms to unprecedented lengths. It's now common to see loans stretched out over 84 months or 7 full years. This tactic lowers the monthly payment, creating the illusion of affordability, but it masks the deeper problem. It means borrowers pay far more in interest over the life of the loan and remain underwater for longer, amplifying the financial risk. The ripple effects of this collapse will not be contained to the auto industry. Insurance companies will face losses from unpaid premiums. The entire used car market will be destabilized by the flood of repossessed vehicles. And regional economies that are heavily dependent on auto sales and manufacturing will face significant downturns. This is not a localized problem. It is a contagion that will spread throughout the economy. Predictably, policymakers may try to downplay the severity of the crisis. They will likely frame it as a temporary adjustment or a return to normalcy after the pandemic. But the data does not support this optimistic narrative. The evidence points not to a temporary correction, but to a systemic affordability crisis. The fundamental cost of living in America has outpaced the ability of millions to pay for it. For the families at the center of this storm, the consequences are devastating. Losing a car often means losing the ability to work. This turns a personal financial problem into a profound social crisis, trapping families in a cycle of poverty from which it is nearly impossible to escape. It's a feedback loop where financial hardship leads to job loss, which in turn leads to even greater financial hardship. This is the question that should terrify you. We've already seen defaults surge past the 2008 peak. We're watching the system buckle under the weight of its own reckless decisions. We're not approaching a crisis, we are deep inside of it. The auto loan collapse may not be the end of the story. It may just be the first domino to fall in a broader consumer debt collapse, as Americans finally run out of ways to borrow their way through an economy that no longer works for them. And it's happening faster than anyone wants to admit.